Let's move on from futures and currency to some really interesting things, which is basically the entire sort of credit and debt markets, and those are really complicated. You can go to something as simple as a trade like this is maybe the most popular trade in the world, and it's a bigger market than the stock market, which is the U.S. Treasury market. People trade the U.S. Treasury market every day. It's a much bigger market than the U.S. market, the U.S. equity markets in terms of trading activity. Debt markets are enormous. And you can see here that the yield, which is inverse to the price, jumps around quite a bit. And in general, it's been dropping pretty dramatically. And we saw this chart earlier, but you can see that U.S. government bonds have gone up quite a bit. Part of the reason is not just the U.S. dominance in the world, but also the lack of inflation or deflation. We see a similar trend with the Japanese government bonds, or the so-called JGBs. When we look up JGBs, there's no good way to do this. They're generic JGB. I thought there was. Look at this. Yeah, you can see the JGB yields are also similarly low, and this is just part of deflation. Does tech cause deflation? What is it? Monetary policy? Is it economic growth? What exactly is happening? We're not so sure. A lot of theories on it. I think it's more to do with technology personally than anything else. But that's the Japanese government bond long-term yield. So whether or not these things are good or bad is up to you. As a trader, you're just simply trying to take advantage of it. Now, these are the 10-year bonds. Now, I mentioned that there are 2-year bonds and 10-year bonds and 30-year bonds, and the difference between these is called the yield curve. And you can actually look at these yield curves. You can do it by hand, you can do it with programs like this, and you can actually, forget dollar swaps, let's actually just look at government bonds. Let's pick the US, and let's look at treasuries. So here's the treasury curve, I-25, and let's actually look at it on a separate date. And look at that. A year ago, you could see that this, in the white here, this is really interesting. In the white, you have the year ago treasury curve. And in the orange, you have this year's treasury curve. And you can simply bet on whether or not this curve will flatten or steepen. And you can see that the flattener trade was better. The 10-year yield has dropped, and the 2-year yield has gone up a little bit. And the 1-year yield has gone up a little bit. You can make $1 billion bet, or a $10 billion bet, or a $50 billion bet on flattening and steepening. And your counterparty would be probably someone like Goldman Sachs, who would set the trade up for you. But if you steepened and you had a flattener on, you would lose money. And if you flattened while you had your flattener on, you would make money. And this is so-called tens versus twos, where you can make it, by the way, any number you want. Goldman Sachs is happy to structure your trade and make a commission, or you can use Morgan Stanley or UBS or anyone you want. But the whole idea is that people trade these curves based on things like inflation and so forth. Bonds in the short end of the curve, you can imagine, have no default risk. Whereas bonds at the end of the curve, say 30 years, well, gee, I don't know if Hillary Clinton becomes president, and then, I don't know, Bernie Sanders becomes president after, and he's 95 years old, and he makes us a socialist country. Well, those 30-year bonds could be pretty risky. Whereas even if Hillary Clinton becomes president, 1 year from now, I don't know that, or Donald Trump for that matter, 1 year from now, I don't know that you could do enough damage to the country. So those are really just basically a proxy for inflation. Whereas the 30-year bonds become more of a proxy for default risk. So how those things move, again, you can see that they've flattened quite a bit. That means that the yield's gone down, so the price has gone up. If I were a trader today, I would put on a steepener trade, where I think the government disarray, you can see by our presidential candidates and our budget and things like that, the inflation's not going to change in the near term, but in the long run, I would imagine bonds will blow out. Now, a lot of people have lost a lot of money doing this trade. In fact, let's take a look at 5 years ago. Let's take a look at 5 years ago. Let's see what that looks like. Yeah, there you go. It's even more steep. So all it's done is flatten, 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 to the point where we're at this orange line, and it's really flat. I mean, it should cost you much more to borrow money 30-year obligation versus a 5-year obligation. But that difference, that spread, has flattened, flattened, flattened. And the reason is, paradoxically, I mean, we're assuming that there is no default risk in the US, and I think that will change. And again, there's a lot more to this. I'm not an expert in this stuff, pretending I am, but I'm just merely kind of showing you what a macro hedge fund does. Now there's things like LIBOR and swaps that trade on LIBOR, floating rate versus fixed rate swaps. I actually pasted this thing from ICAP, which you can actually look at, and then also this academic study. And again, if you're having trouble finding this, there's a link in the description box, and I'll post it again. So there's all kinds of things you could do with respect to the yield curve, or you can make direct interest rate bets. Again, the LIBOR and the Eurodollar are floating and fixed rates that you can trade around. There's options on these swaps. These are all generally called swaps. And the debt markets are fascinating. The other part of the debt markets include things like CDS. You probably know CDS as debt insurance. So let's pick U.S. government CDS to look at. Well, the U.S. CDS is very, very low priced. It costs 26 basis points to protect an entire portfolio of U.S. government bonds. There's almost no risk of default. Now, if the presidential election goes in Trump's favor, I bet these will bounce up quite a bit. But if you take a look at Brazilian CDS, Brazil is in a country that's in terrible straits right now. They keep firing their president and so forth. And for a while, there was some fear that Brazil could go bankrupt. And you can see that the CDS jumped up to 500 points. Now it's down to 256, but that's sort of like a 2% chance of default, which is really kind of interesting. Now, if you look at Greece CDS, they basically already defaulted, right? But it's 10 percentage points. So you have to give up 10% to insure your bonds there. Now, there's also CDS on companies. So you look at like Amgen CDS. Amgen is very unlikely to default. You can see it's actually less likely to default than a company, mind you. And a company can do anything wrong. In fact, default just means you miss one interest payment. One interest payment. Amgen could have a drug that kills somebody or something like that. They could raise prices like buffoons. Who knows what they might do. But regardless, the cost of insuring Amgen bonds is extremely low. And you can have some fun with this if you actually look at the yield on Amgen bonds. There's no free lunch. So take a look at Amgen bonds. Let's pick, I don't know, some bonds like here. Let's see what they're yielding. You can see that they're yielding 2%. So if you insured these bonds, they'd be yielding 1.5%. You can see they're 70 bips above treasuries. So maybe you can have, in a perfect world, 20 basis points of so-called free money. The problem is they're not that liquid, and as you tried to put these trades on, your arbitrage would vanish. But there are sometimes, in real big panics, you can actually lock in some of these arbitrages, believe it or not. CDS are notoriously not transparent. Those are CDS rates. All right, so there's all kinds of alphabet soup here, like CDO-CLO, which are collateralized debt and loan obligations. There's mortgage-backed securities, asset-backed securities. There's catastrophe bonds. There's all kinds of cool stuff that you can trade as a macro trader in practice. And there's exotic trades that I haven't even talked about, like weather and other really crazy stuff. You can make custom rates, like instead of LIBOR, you can have all these nutty kind of interest rates. There's volatility, what we haven't discussed, trading volatility, which is its own kind of nightmare.